So, hi everyone, I'm Anna, and thanks for joining us today. We are Epic Events, the organizer of today's Fintech Panel and Pitch event. Epic is an e-commerce website for frontier technology products and events. Frontier tech includes AR, AI, blockchain, robotics, biotech, and other bleeding edge industries. Our mission at Epic Events is to ignite ideas and expose technologies that will underpin future society. Today's event is the State of Fintech Industry VC panel and startup pitches. Fintech has been on a tear over the past couple of years, but the coronavirus outbreak has ended this growth at all costs environment. Our Fintech panel of VC investors and industry experts will discuss how the coronavirus impacts their investing and the overall impact of the outbreak on the future of the Fintech industry. To kick us off, I want to introduce Maya, who is our moderator. Maya Kanehara is a facilitator, executor, and mentor. She is passionate about innovative technologies and services that transform lives. She has over 15 years of experience in product development for tech companies like Twitter, Apple, and Autodesk. Prior to her current role as a managing director at Self-Sovereign Identity Incubator, she was a VP of Growth and Development at Digital Garage US, where she strengthened and maintained a centralized business development process for portfolio companies and corporate partners. Maya mentors early stage startups at 500 Startups, Alchemist Accelerator, and Orange Fab. Let's welcome Maya.
Thank you for the introduction, Anna. I'm very excited to moderate this event. We have amazing three speakers today, Dan, Alex, Sheila. To our audience, would you like to introduce yourself, your firm, structure of your fund, any investment thesis, and any prior notable investments? In short, what do you look for? Dan, you want to kick off?
Sure. Let's make sure I'm not muted. Yep. Hey, everybody. My name's Dan Rosen. I run a firm called Commerce Ventures. Started the firm 7 years ago, but I've been investing in venture capital for about 20 years. And I've been investing in fintech for 13. And my prior firm, Highland Capital, before this. So at Commerce Ventures, we invest in infrastructure enablement technology companies that are enabling the future of retail and financial services. We've invested in about 65 companies to date. We're on a third fund, which we raised last year, a $65 million fund, typical GPLP sort of approach. And some companies you might have heard of before that we've invested in include Marquez, Bill.com, BillGo, Inoth, Kin in the insurance space, MX, Socure, and a few dozen others. Our approach tends to be a very sector-driven and thematically oriented approach to investing. So we'll typically start with a theme and try to work our way towards making investments after speaking with ecosystem players and a bunch of startups. But happy to talk more about what we're looking for specifically. That's a little bit of background on us.
Sheila?
Hi, Maya. So hi, everyone. I'm glad to be here. Certainly, Dan has a huge background in investing. Mine is, I guess, the opposite direction in the sense I'm being focused more on the product side, working at larger companies. Worked at Amazon, Western Union, Cisco, Google, a bunch of companies focused on digital products, a lot of focus on fintech and e-commerce. So my background really comes from, actually rolling out products, understanding markets and customers. I am kind of new to investing in a sense, I have been at it only recently. The last couple of years, I have myself, worked with startups, individual startups, advised them, and some of them invested myself. And what do I look for really? The 4 M's, looking at, what your market is, how well do you understand your customers, what problem you're trying to solve, looking at your business model. I would also look at your team. And then, what returns you can bring, how well do you monetize is what I would be looking for. Those are the 4 things I would be looking for.
Alex?
Yeah, hi, thanks everyone. It's Alex Marquez. I run Experian Ventures. I've been doing venture capital for the last 20 years, some time spent initially with Intel Capital in the digital media space, then a couple of years spent in additional CVC roles at USAA, and then now running Experian's venture program, thematically focused obviously in the fintech space, in and around enabling of Experian's core business model. Obviously a big data analytics play globally. So I guess the difference here would be that we have a sort of a global footprint in terms of our portfolio of investments. I'll try to bring some of that context to this conversation today, but we have investments in North America in companies like Finicity, TrueAccord, a couple others in the healthcare space, as well as similar opportunities in Germany like Bonafide, or in India and Bank Bazaar, or in Southeast Asia and companies like Genexu, C88, and Compare Asia. We look for everything we don't do early stage, I should say, thematic, if you think about thematically, but from stage perspective, we tend to find ourselves doing investments where there's a good strategic alignment, which then means there's more of a company that's later stage or growth stage, where we can have a partnership in place that somehow benefits Experian in that relationship. So I'm looking forward to the conversation today, and hopefully I can add some different perspectives and values as I see internationally.
Thank you for the introduction. Obviously, the coronavirus has dramatically changed our lives. For instance, gig workers got hit a lot in the coronavirus pandemic. Uber and Lyft drivers are out of work. Supply chain like Amazon, Walmart, CVS Health are hiring more than 500,000 employees right now. Do you remember your investment theses and predictions heading into 2020? What were they? What were your strongest convictions? Dan and Sheila, would you like to talk about Silicon Valley and North America? Following Alex, would you like to talk about international markets, since you've been investing in Indonesia, Philippines, Malaysia, Brazil, and Germany? Dan?
Sure, yeah. So I'd say largely speaking, our investment themes going into the year are still the themes that we're pursuing today. We're doing usually somewhere between 6 and 10 sort of thematic deep dives per year, at varying degrees of depth. But the ones that we had kind of coming into the year were healthcare payments, really healthcare as it intersects with financial services. And we've made a couple of recent investments in that space. We were pretty excited about collections and loan servicing. Actually, going into this year, we have been for a while. We've sort of struggled to find kind of the perfect combination of the 4 M's, if you will, in that space. But we think there's lots of opportunity and need there. And I think now we're all sort of seeing that's going to be important in the future. Commercial payments, I'd say, is another area that we would spend a lot of time on, and invested in a couple companies in that space already. Fraud prevention continues to be an ongoing theme for us. We've made several investments in that space. We'll probably make more. And then I say frictionless checkout, which is probably more relevant to the retail side of what we do. But we've made a few investments in that space, and I think we'd love to see more of the extension of that beyond traditional retail into kind of other categories of consumer spending, frictionless checkout, check-in kind of areas. So those are areas that were exciting to us before, continue to be exciting to us now. I don't think that's changed all that much for us.
So I would say that certainly with the COVID-19, I think there will be new emerging themes that I would be focused on. Like I said, I'm very new to this in terms of investing, and also more focused on early stage compared to the other 2 folks, right? So for us, I think we're more focused on new emerging trends that are happening due to COVID-19, which we'll cover in a minute. And I am happy to go into details then. I think that might be the right appropriate time to, kind of explain what we're doing.
Yeah, at least for us, our focus areas hasn't changed so much. I think they're perhaps expanding a little bit. So internationally, looking in Southeast Asia, or actually more broadly APAC speaking, we had a significant emphasis on what we call marketplaces. So this is direct-to-consumer portals, et cetera, the Credit Karma equivalent, if you will, that exists in the emerging markets. And the thesis being that as consumers come through a direct-to-consumer play, that there's a way to facilitate access to credit facility, credit product, and we would be able to facilitate that access because we have a tremendous amount of data on the consumers in those regions, depending on whether or not it comes from a market where we have a bureau or a market where maybe we have alternative data coming through telco or something else. That is still the same thesis. It does play out differently in regions where we do and do not have a bureau. So there's a significant difference to lift when it comes to the funnel. So that's been one macro thing that's been played out in the APAC region. We've tried to play that a little bit in some of the European regions in UK, where we've obviously pursued some acquisition opportunities in the UK, but we then pursued and did an investment in Bonafide, which in Germany, which is similar to a Credit Karma play. So we're a small investor in there. And what I'm saying is we have emerged a little bit beyond marketplaces in those same regions, looking now more at the e-wallet plays, because the e-wallet providers obviously have a lot more transactional data on the consumer, as opposed to some consumer coming through a funnel looking for a financial product. You have a lot more transactional data on a monthly basis. So the e-wallet providers in APAC are pretty much top of mind. We did do a small investment in Brazil in Recarga Pay, which also similarly has a lot of transactional data through their mobile wallet. But we're also a small investor in Grab in the Southeast Asia region. But I think to Dan's point, we haven't changed anything. Thematic-wise, I think the one additional thing I think has come to light most recently is increased focus on identity and digital identity management. And there's a big play, we'll talk about this later, about the impacts of COVID-19, how it's had on eKYC processes, especially in the emerging markets.
Great. Let's talk about the current situation in the context of the last two recessions back in 2000 and 2008. What did you see happen in the last two recessions to serve as a reference point for what may happen here? What happened the other two times for the industry? What's different? Do you see any similarities?
Anyone want to take it? I mean, I'm happy to jump in. I'll go first. It's a great question because, obviously we get asked this a lot. How does it compare and contrast to prior trends, prior events in 2000, 2008? I'm not old enough to think back further than that. But the way I best describe it is that at least in 2000 and 2008, you could see the train wreck coming over time, right? You saw the dot-com bubble build up, and you saw the sort of irrational exuberance around valuations of these companies. And in 2008, you obviously see some of the valuation bubbles building up on the real estate side. The way I describe this most current event is more like an earthquake, right? Because it was a sudden jolt to the system that nobody anticipated. But the byproduct of this earthquake event, really a traditional black swan event, was that you had all this destruction that happened after the fact. And people are just trying to figure out how to, recover from the destruction that happened so suddenly and unannounced. And so I think that's the difficult part to compare and contrast to the impact it's had so abruptly. The outcome of this is even more complicated because you had an immediate drop off in unemployment, and then how that's going to trickle through to people coming back into the workforce with all this physical distancing and the impact it's had on the financial business, the companies that were invested in that are in the financial services space, where, especially in the APAC region, where, physical presence has to be there when you want to apply for a loan or you want to do a signature on a document. So that to me is the most difficult part to predict on a go forward basis, because so much of the opening of the market is not predicated on just putting, labor back to work, but it's about the governments and allowing people to get back to work.
Yeah, I wouldn't disagree. I think, those of us who've been doing this a while on the investing side probably have a sort of a similar, lengthy perspective. And that really helps when you think about kind of how to respond and how to help your portfolio companies think through, navigating this environment. There are many sort of similarities and many differences between the previous recessions. We spent a lot of time looking at this and what the implications of COVID will be on financial services and fintech specifically. In fact, we've actually published, to Alex's point, we've published some Medium posts just talking through what we call the three waves related to COVID, which is just kind of the first wave is really the initial consumption shock, which is will mostly not hit financial services except for around retail related payments and probably SMB lending. And then the second wave is where you could see sort of a liquidity crunch, and that could really ripple through financial services in a more negatively impactful way. And I think about kind of how do we work with our portfolio companies, or how do we sort of counsel our portfolio companies? I think what we would expect from this downturn is that just capital transactions will slow down, and they'll slow down because they're just generally speaking, there will be capital constraints, but also because I think there's fundamentally, we're in the middle of a point of disequilibrium in the market where, kind of buyers and sellers don't have the same pricing expectations. And so, what will happen there is anybody who doesn't need to execute a capital transaction won't. And those who do will probably suffer in terms of the valuation. So you should see fewer M&A deals at scale. I think if you see fewer growth equity investments get completed, even fewer earlier stage investments, although, that's slightly irrational, but it's just sort of, the nature of the, kind of the situation. So our advice is, to our companies and to companies more generally, make sure you have, a pretty clear, kind of path and runway to get through the immediate crisis, which is really health driven and consumption, shock related, and ideally through the sort of subsequent earnings announcements that will come through in Q2 and Q3, and throughout the rest of this year. Hopefully next year things normalize a little bit, but for those companies who can wait, we're definitely counseling them to try to be able to wait, and companies who can't, we're working actively with them to figure out, kind of approaches that give them a little bit more runway, or, if we have to, kind of helping them, kind of gather a little bit more cash around, kind of insider syndicates. But yeah, it's going to be, I think, a little bit choppy for companies trying to raise money in the next, 3 to 6 months.
Great, thank you for talking about your portfolio company a little bit. Maybe Alex, you want to add about what is going on in your current portfolio companies. I saw the letter that Sequoia Capital sent to all their portfolio companies. Did you provide similar guidance to your current portfolio companies?
We provided very similar comments, and Dan kind of touched on it, right? I think one of the headlines we advised them was you sort of have to plan for the worst and hope for the best right now because of the uncertainty around it. I think most of the companies took it literally at face value and made the cuts abruptly because, in the US, I think that one of the key differences is, right, you have a government that can backstop $2 trillion in funding, right? But you don't see that happening out of India. So some fundamental differences here, just to give you people context, right? You have a PPP program in the US issued by the SBA that provides some financial backing to small and medium business that can apply for and qualify for it. You don't have that in India. And you also have labor laws, for example, that prevent you from outright letting go or laying off employees. So what you end up seeing is that you'll see a reduction in salary as best you can, even though the entire banking infrastructure is shut down. So revenue is effectively dried up for the month of April or May or however long, yet you still have to carry the expenses. So you now have this other challenge where you can't reduce the expenses as much as you can to extend the runway. But at the same time, you're trying to extend the runway. So it's this weird dilemma where I think you'll probably find the big incumbents who are cash rich actually will come out of this much stronger because you don't have the backstop of government funding or other sources of funding and in an infrastructure layer that allows the startups to survive it. So it's an unfortunate situation, but the byproduct of what we're seeing there is also that a lot of these economies are manual driven. So a byproduct of that is in order for the banks to get back in the flow, bringing volume to the door, whether credit card or small loans, small personal loans, is that they have to shift from a traditional manual process to a digital process. And so it's an interesting byproduct. It's forcing the transition from analog to digital, which hopefully will put everybody in a much better place and improve economies of scale for the digital players, there, especially ones that have true straight through digital processing, and some do have them, like in India and some in Indonesia, in China, or I'm sorry, Hong Kong. And so that's what we are seeing. But the hardest problem has been trying to get a control of when the turnaround is going to happen and how you can extend the runway, because to Dan's point, it's real difficult to raise capital in the next 3 to 6 months.
All right, Sheila, do you want to add anything?
So no, I definitely echo what Dan and Alex were saying. I think acceleration to digital transformation or banking transformation is certainly one of those trends that is going to garner a lot of speed. We've seen companies approach banks with major legacy systems and taking 2-3 years to even get a POC, and many more to actually deploy something. And I think all of those conversations are much hastened. Also, if there was any conversation happening within the bank, whether, budget should be allocated or expense should be allocated to digital transformation, I think all of those have kind of evaporated. And there's a clear use case and clear reasoning for going digital. I think that certainly we've seen quite a bit. The couple of other things I would add is with COVID-19, I would say that if people are using alternative data to underwrite and score, with newer, I think, alternative data, now is the time we will see really how good they were and those models were, right? So all of the information that's going in these models could be reevaluated. Maybe there's tweak to be done, or maybe there is access to alternative data that you need to bring in now, because now is the time, right? Then I think other things like Alex mentioned, digital workflow itself, banks with the bank branches being closed, everybody is going digital. And since digital is the focus, also the focus is on good CX, Having an experience for a customer that is delightful is also very important. And I think making it easy really for the customer to interact is one of those things that will take center stage. So those things are.
Yeah, I think it's a really interesting point that Sheila's making. I think there's this sort of like in both of you guys mentioned it, there's this acceleration of digitization that was already kind of underway. But if I think about, folks, kind of tending to be, laggards, maybe a little bit older than us, my parents included, like they really just my parents haven't used online banking all that much. And it's like, finally, they're like, okay, we get it. We have to use digital banking. Like that's the only option right now. And so I think the good news is like you're seeing the conversion of that laggard portion of the population, which I think has forced banks to reevaluate kind of how good actually their digital capabilities are, even those who have some, but it's not that good. And the other piece is I can't help but wonder what the really awesome, but not yet really, kind of like live experiences that could exist should be around retail banking. Because, I think about it, like it's one thing to go shopping. Some people like shopping. Sometimes I even like shopping, but I never like banking. I mean, I never really enjoyed going to a bank branch, and I don't think many people do. So, there's sort of this idea, like if you could sort of imagine a retail banking or financial services experience whereby you could be face to face the way that Sheila is on my screen right now, in the moment that you want to talk to somebody, or, kind of where it fits into your schedule, and have a personal conversation with somebody be done very quickly and have that be delightful. Like it just, that is like 1,000 times better than physical retail banking is today. I don't know what the fintech portion of that is other than the infrastructure and the sort of digital capabilities around it. But like, gosh, that really feels like the step change we ought to expect here in the US. So that we're sort of thinking about that. That's one of the areas we're thinking about now. We're like, what's the opportunity there in terms of investment? I'm not sure, but it does feel like that's coming.
So Dan, I'll add to that in the sense that, yes, going digital, but then like what Alex was saying, improved KYC, right? Initially, maybe we were uploading documents, but now with video, you're even more confirmed that is a real Sheila sitting at the other side. You know what I'm saying? So I think those kind of underlined, capabilities, enabling of those will suddenly improve for the other things that we were doing, right? Immediately. So I think that's
interesting.
Yeah, those changes have definitely moved up the priority list. I mean, I can tell you very confidently in India that I think we had no banks signed up for eKYC. And now there's one live, and there's, I think, 5 or 6 now in pipeline. And this is literally in the last 4 weeks. So years of trying to get them to adopt an eKYC platform. Overnight, they adopted it. And in our company, Jernexu in Indonesia, they had 1, and now they have 8. And so it's amazing that it just forced that aspect of the Dan's point, the old legacy linear systems have now been forced to move to digital. And I think, hopefully, that now that the genie's out of the bag, there'll be less impetus to go back to the analog version of it. I'm sure they'll still keep people, doing physical, but there's probably no reason to go back. So hopefully the majority of the shift will end up in the digital bucket.
So interesting. We still have a couple more questions, so I'm gonna move on to next one. Will fintech startups be able to close funding now and in the near future? On the investment side, what is everyone doing in the present, next 6 months and beyond?
I'll let the people with the fun talk here. This is about
Dan's video is frozen. I don't know if we lost Dan or not, so I'll go in the meantime. But oh, there you're back. Yeah, I think there's the entire spectrum of what VCs are doing right now. There's the spectrum of managing the portfolio of investments we already have. In our kit situation, we deployed about 200 million in the last 3 years. Certainly a large emphasis, because we're strategic, right? There's a large emphasis on ensuring that the bets that we placed will survive through this, as opposed to adding more new to portfolio investments. But we're not, we're still looking. We're just not going to probably be as active. So I think that kind of supports the point earlier about it's going to be really hard to raise capital in the next sort of 3 to 6 months. But still very active looking at the opportunities. It probably, if you're in the receiving end of a lot of the meetings with VCs, you probably know, quite honestly, that not as many are going to be issuing term sheets now. If they are, they're going to be materially different in terms of valuation. Whether that's a good or a bad, it's kind of TBD. But you could also make the counter argument that the pendulum has shifted back in favor of the investor as opposed to what it used to be in favor of the entrepreneur.
So I would say if you're a startup early stage, it's going to be very difficult, and everything that has already been covered. If you're a late stage startup and you are open to discussing your evaluation and being acquired, I mean, we've seen certain companies, right? And the pendulum has certainly shifted in the favor of the acquirer, right? SoFi acquiring Galileo. That's just one example, right? So you can, if you're open to being a late stage company and getting acquired, you have a solid product, solid market. The incumbents are still looking for access to market, access to customers. In fact, they will take this time, if they have a good balance sheet, to be able to acquire a company that has, a solid product, a solid market, and access to customers they have been trying to get access to. So I think this is like the perfect time for that. We've seen great startups, whether it be Stripe or Brex, raise a small round. Certainly, those are available. IPO market certainly has vanished, but what about M&A, I think those things certainly exist. It all depends on where in the cycle you are. If you're very early stage, I would say stay your course, reduce your expenses, be open to a better or a worse term sheet, what have you. And also it depends on what part of fintech. Fintech is really broad, right? If you're creating something that is maybe on the investment side or banking side, there is certainly a lot of traction there. But if you're doing other products, fraud is another one, right? Identity is another one. So it depends on what area of fintech you're working on. Those might be more attractive or up there right now in terms of investments. Others, it's just about staying the course. So that's
just additional data on that as well. Like if you go look at post 2000 and post 2008 data from various pitch books, what have you, and you see the drop off in number of deals done and then the drop off in dollars deployed. It's not a similar ratio, right? There's like a 25% drop off in number of deals and maybe a 50% drop off in quantum of dollars deployed. And so I read into that saying, they're just doing fewer new deals. And so the transactions that are getting done are being probably deployed more towards existing portfolio. So yeah, by default, folks are probably going to have a little more emphasis on existing portfolio as opposed to deploying capital as new to portfolio.
So one of
the interesting, I missed this. I missed the question a little bit when my connection dropped. But sorry, Sheila, go ahead. I can wait for you.
No, Dan, go ahead.
Okay. Yeah, I was going to say the interesting thing to think about for the startups listening in is in the same way that probably many startups are trying to figure out, hey, how long can I outlast the worst of this before I have to go raise? You should keep in mind that, we've had an explosion of emerging managers, I mean, ourselves included, over the last, kind of 7 to 10 years, firms that got started and raised their first or their second or the third fund. And so folks in that world, and even folks in the traditional VC world, kind of are facing the reality of needing to come back to market at some point in the future. And if, their track records weren't yet proven, or if they were looking good, but then they got, sort of hammered in this downturn, like you could imagine that, even VCs are going to be thinking about, how do I make my, current fund last as long as possible, so that I can ensure that I have something to show investors next time I raise money. So, that will also be a factor for slowing the pace of people writing checks. So just, keep that in mind.
Yeah, I'd add to, I don't know, Dan, if you have this in the portfolio from an exposure perspective, but I think what has been exposed through this downturn is those business models that were heavily dependent on, direct-to-consumer customer acquisition, right? Because there is no more customer acquisition, especially in some of the emerging markets. And so that's where I think the resiliency or the durability of some of these businesses have come into question. Now, whether that's right or not, I think, but that's definitely one of the key things we see out of this today.
Yeah, the areas within there that I'm most concerned for, I mean, the challengers in the sort of core financial services world, especially lenders here in the States, and then of course, I'd say subscale deposit players, candidly deposit players generally, but most of the subscale deposit players. I think it's actually not that expensive to acquire customers right now, because kind of the price of advertising has gone down so much, but people aren't generally moving bank accounts, and the warehouse facilities that a lot of these alternative lenders have relied upon have gotten pulled like all over the place. So it's funny, because you see the backlash in the sort of the social kind of the press and the social kind of media, but there's really a lot of times it's beyond the control of those lenders. And so I think those are the most challenged places, we at least from what we see.
So the quick point I was trying to make was that, last time in 2008, we were comparing this to 2008. In 2008, when the recovery started, I think the early stage investment recovered much better and faster than late stage folks that had been at it for a long time. So, we are talking about, we are in the pandemic, and of course, certainly investment for early stage is very difficult to get. But also focus on when it does turn around. I don't know if it is going to be the same, but certainly that recovery could look completely different in terms of funding, right? And maybe Dan and Alex are better suited to answer what will happen during the recovery, but certainly that's what happened in 2008, right? So that's something I think early stage people who are here on this call could keep in mind, right? It is bad right now, but it doesn't mean it's going to be worse continuing for you.
Yeah, I think there's a lot of reasons to be optimistic. I do think it is harder to be a challenger than an enablement player. There's a long history, of tech companies that serve financial services, kind of having, really successful paths to liquidity. There's sort of a very defined set of acquirers. It's a broader set now than it ever was before, and those are very healthy players: the Visas, the Mastercards, the Fiservs, the FISs, et cetera, et cetera. On the sort of challenger side, I think it'll be a little bit of a tougher road. Although interestingly, for the first time, I think in the last 10 years, we are seeing financial institutions really explore seriously, M&A of venture-backed players. I think they're primarily looking for deals. So I don't think those are going to necessarily be the best, sort of outcomes, but they could be, sort of safe landings for companies that have raised a lot of money and have built a good brand. So
that's a very good point. It would be interesting to see, to Dan's point, if there's a pickup in existing sort of incumbent legacy players going off and picking up distressed assets in the sort of fintech startup space. I would think so, right? Because I was hoping that this part of this is sort of the impacts of COVID was going to be kind of a washout in the excessive funding in a lot of these fintech players. I mean, it's my personal opinion, it's been overfunded, but and very little differentiation, especially in the challenger bank space. But like anyone who's in a venture fund, right? You guys have a long view on any industry, and so this is a blip on the screen. So whether or not 2000 was a blip you learned from it, 2008 is a blip on the screen. Hopefully it's more activity coming out of this, and for someone who's price sensitive, this is probably the best buying opportunity right now if you're still long in fintech.
Yeah.
And unfortunately, as we all know, right? So innovation doesn't slow down, as I've said before, that it doesn't slow down in times of economic stress, right? At best, you're probably seeing the most durable business models survive through this down cycle, and you may even see more creativity come out of it because there's a lot less capital to freely throw around, and you got to be very cognizant about the dollars that you do deploy on product innovation.
So talking about incumbents, I don't know if you guys saw the news yesterday with FIS announcing a $150 million fund for early stage, right? So that's just an example again, of course they spent a lot more money on acquiring WorldPay, but then that's a different story. But having said that, the 150 million is a small amount for them, but still focused on early stage, right? So that does tell you something, right?
Yeah.
Okay, so everyone, we are running out of time, so we have to wrap up. Any last parting words, thought, or words of advice for startup having to navigate fundraising or operation in the current climate, or fellow investors looking for great companies?
I'll let the wise man go first.
I don't know. I think this sort of feels like what we were talking about before, but I think we've seen a few downturns. The venture industry has weathered a lot of downturns over its life, but in modern history, we've seen a couple in 2000 and 2008. And I'd say 2000 was a disaster for the venture ecosystem. 2008 was tough, but not as bad as 2000. And I think it's important to remember that, in the US, so much of what we produce here is actual intellectual property, right? It's bits and bytes. Several of the largest companies by market cap that are based in the United States are companies that were formerly venture backed: Microsoft, Amazon, Facebook, Salesforce, Google, Alibaba. The list goes on and on. So I think it's important to keep that in mind. It's bad now. I think it's going to get a little bit worse in terms of just the numbers that come out into the market and where the market moves, but it'll end at some point. And so it's really important to keep that in mind and keep your wits about you and just be rational about this. And if there are, if you're facing challenges, keep it in, kind of context and recognize that it will end. And at some point, things will start to look better every day rather than potentially worse. So that would be my piece of advice.
Yeah, it's good advice. I'd add to that just that, as entrepreneurs, right, you weren't sort of trying to build a company based on a singular event or trying to make your way through COVID, right? You're trying to solve a bigger, broader problem or an unmet need. So this should be not as a distraction, other than the fact that it is more challenging in terms of raising capital. But to Dan's point earlier about all the great companies that started in the last couple of recessions, this is probably the great filter, if you will, on some of the better ideas. And so if you can cross that bar and raise capital, I think that it probably speaks more volumes to the sort of viability of the business that if VCs, given the sort of current environment, are still willing to put capital into your startup. They probably have a ton of conviction behind the value proposition you presented. So I put that out there. But the flip side of it, I also remind everybody who's a VC that VCs sit in one sort of spectrum of the world where we dole out cash, right? We also got to be super sensitive to these entrepreneurs who have to go through incredibly difficult times of trying to figure out how to preserve capital, how to retain employees. The broad impact of this, as we all know, that's been publicized is, millions of people are gone unemployed. Whether or not it's impacted our portfolio is kind of TBD. So there's a bit of, you just got to be sensitive to the fact that other people are suffering. I don't know how also to describe that. I described it in a LinkedIn post with a couple other folks, but just got to be very sensitive to the fact that it's a difficult time for a lot of folks. And the best we can do is kind of help these startups get through this phase and provide them as much guidance as we can to get through it, because it's not a trivial path to navigate.
I would say that yes, it is very difficult. And also this whole pandemic has given us a perspective on what's important, right? Entrepreneurship is very glamorous. We know it's going to be difficult. We, as an entrepreneur, would have expected to meet a storm. You've been hit by a tornado, right? So this is your time to shine. You will have great stories to tell your investors once you come out of this. Preserve your cash. I think focus on profitability, whether it's this time or ever, I think that is always of importance, and value that you are healthy and family is healthy. I think that is most important, right? So focus on what's important, do your best, and I think we all will come out of this glorious. It's just a matter of staying course and keeping your chin up, really.
Right, thank you so much. We still have a few more minutes. Let's have a Q&A here. Anyone has a questions from audience? Anish, can we?
Oh wait, actually, let's cover the question that was asked near the beginning from Thomas.
Oh yeah, yes, Thomas.
It was just, shouldn't startup focus on extending their runway, at least for the short term, I think was the question, right?
Mm-hmm.
Yeah.
Yes.
Well, Dan, I think you should answer it.
We talked about it, but I think the answer is yes. Look, I think within reason, right? It's like, you can sort of, you can hopefully trim off fat and maybe cut a little bit of muscle, if it makes a meaningful difference. At a certain point though, a company that exists but isn't exciting doesn't raise money either. So, I think you want to live to fight another day and raise more money, but it's got to be in the context of still being able to satisfy some minimum threshold of delivery on something exciting. So I would try to keep sort of cutting burn as one of several things that you pursue to fund your business through to the period of time where you can raise money. Obviously, it's the easiest thing to control as an entrepreneur, but you obviously still have to do your day job.
Yeah, I think we've taken another added layer on that, which is like one of our companies in APAC region, that any dollar that's being spent should be spent towards something that's generating revenue. So if it's not directly revenue generating, question whether or not you need to actually spend it.
Awesome. So shall we move on to one more question? I think we had
from Ray's as well. I think
yep.
It was, how open are VCs in the US to investing in UK scale-up companies looking to expand into the American market?
This is what US VCs investing in the UK to come back to the US?
Ray's, if you want to elaborate on your question or clarify, you may do so if you're still with us. I will allow you to talk.
Thanks very much, guys. It was just a quick question. We have lots of companies with ambition here in the UK. They've got to a certain stage and they see the US as a prime market and they're looking for opportunities. So it's whether they raise here and then make the leap to America, or they make the leap to America and looking for US VC funding.
My pressing question to international expansion is always the same, is depending on where the business is at in terms of scale. If you haven't been able to scale your business domestically in the UK, I question why you're trying to scale internationally outside your domestic market. And so that's just a question of where the business is at in terms of scale. But add on to the fact that there's been several companies obviously have made successful leap over to the US, whether that's from the UK or elsewhere. I think there's a tremendous amount of competition already in the US. And I don't know what the businesses that you're talking about specifically, but my leading question always is the same one, which is, why are you expanding internationally if you haven't scaled yet domestically?
And maybe just to add to that, it's worth thinking about, unless you're a company that has dominated the market you're in and you perceive that you need to expand to address a broader market, which could be a natural way of thinking about it. But if you just view that like it'd be better to be in a bigger market to get going or to start, I think just think about it as a complete wholesale move of your business, or at least the headquarters. where I've seen it work for companies, that's the approach they took. They said, not that they had to move their whole team, but you can't sort of kind of open an office in the US, at least in most areas that are relevant. You sort of have to commit to it as a primary market. So I think you do that if you're willing to commit to that hook, line, and sinker, and really formulate almost, whether it's formally or not, like a headquarters in the US where the principals of the business are willing to spend a lot of time, if not relocate.
Yeah, I 100% agree with Dan's point. I've just been part of more international failures than I'd like to admit. International expansion failures.
One quick thing I would add is I would ask you, what test have you done so far in that market, right? There's always a good reason to enter a market and a bad reason not to, So I would ask you, what testings have you done? Have you tried to, test out the market? And is this the right time to test it out? I'll give you a simple example. Marquez, which is a company that Goldman Sachs owns, they announced a payment wallet, a mobile wallet, right? And the question was, is this the right time to do it? And there could be, again, several reasons for doing it. I think it's a great time to test out, right? Because people are, trying to accept their stimulus check into a mobile wallet, what have you, right? Also, contactless payments is taking off. So there could be reasons for doing that. So I would say, what are some of the indicators that you've seen that are propelling you to launch this market is something I would love to understand if you came to me.
Great, thank you so much.
Okay, we just had another question in the chat. Would switching focus toward COVID-19 specific uses or modifications make an early stage company more attractive for investment? Which actually, for as someone who does get a lot of companies applying to pitch, I've certainly been seeing many that have that are showcasing the relevancy to COVID-19. So maybe you guys can do that.
Yeah, look, I mean, it's my answer to that would be I'd go back to what Alex said, which is like what you're aiming for generally is, solving a problem that, kind of is probably a 5-10 year problem of an industry. And so if I think about fintech or financial services, those shouldn't be pulled off track by COVID so much so that you switch what you're doing to being related to COVID. But that said, it's hard not to, everybody is showcasing, of course, like how they function in a COVID environment, especially because it seems like it might be around for a little while, at least the way we have to approach social distancing. So, if there is a way to highlight why you are better positioned as a result of this, that is, I think, a positive. I would definitely not change the core message of what you're trying to do to be related to COVID. That will not, I don't think, make experienced VCs more excited about investing in your business, unless, of course, what you're doing is something in healthcare. But I'm guessing people on this Zoom meeting are not in that space.
Yeah, I 100% agree with Dan on that point as well. If someone sends me a business plan now and it's got these COVID layers on it, one, if it's healthcare related, that's to Dan's point, but it sort of immediately flashed in my mind. It's like when blockchain first came out, companies said, oh, by the way, also we use blockchain. It became irrelevant to the underlying agenda or the objective of the business.
Right.
It became a distraction that was probably net negative to the initial value proposition than anything else. So I wouldn't include COVID-19 into your presentation if it's not relevant. It is what it is. I don't know if any fintech startup is specifically focused on COVID-19. To your point, it's probably got to be a healthcare play or a contact tracing play or something along those lines.
I would add savings to it, along with healthcare payments, maybe savings. I think everybody is so focused on saving right now. So if you have an app that, and savings has always been a problem, very difficult to solve. Shopping has been 1 click, savings has been 3 clicks. If you look at it, people in the US and around the world save very little. So I think if you have an app, and COVID-19 is like the perfect environment for you to launch and to be able to, again, test your concepts or deploy a product. And so if you have a product that is focused on savings, and certainly along with healthcare, of course, I would definitely add that to it. At least from my side, I would add that.
And then let me add one point. I'll go back to the sort of early comments you made, right? Where we have seen the positive lift as a result of the byproduct of COVID, meaning shelter in place, was in eKYC and identity, right? So when it has a positive implication to the business model, and we've seen it, right? So we see the KPIs in these portfolio companies, then yes, go ahead and leverage that. But it's not, it's not a COVID-19 story, other than the fact it's helped, continue the trajectory of a lot of the identity companies.
All right, guys. Thank you so much for your insights. Now we're going to switch over to the pitch portion of the event. So I would like to invite our first startup, which is Benjamin Cavallari of Tunnel. So give me a second to add him. Oops.
Hey everybody, how you doing?
Hey.
Great, thank you very much. I can see that I'm in your group now, so I'll just share my screen and kick it off. All right, here we go. So let's do share. All right, and let me know if you can see this. It looks like you can. I'm gonna put this in the full screen right here. And this looks good so far. All right, thank you very much. Hit the old timers, like we're respectful of our time. Thanks everybody. Thank you, Epic. Appreciate the opportunity and for you doing this. This means a lot to everybody, I'm sure, all around the world. Tunnel is the world's first cross-currency, real-time, instant settlement global payments network. Basically, it's a payment solution built on a proprietary distributed ledger technology that we've developed from the ground up, and it represents literally an evolutionary jump for the payment systems of the world. What Tunnel is, and we've been working on this for 2 years, Tunnel is a global real-time payments network that is, first of all, cross-currency. Secondly, it is fiat-based, and it's built on our proprietary DLT, which I'll just state right now, doesn't have any elements of the blockchain or any crypto involved, but instead is a high-performance ledger that speaks to the front end of a bank. Now, so Tunnel is a global payments network first, of which we can build products on top of. And the first product that we're launching, which will be this year, will be the only peer-to-peer application, because of our compliance platform, that we'll be able to launch in the United States and be able to offer peer-to-peer payments for any individual teenager and up, so 13 all the way up to 105. And essentially, as I'll detail on a slide coming up, it's based on our architecture, based on our compliance package, based on the way that we talk to the bank, and based on our digital identity solution that allows us to have this untapped market like a blue ocean, representing a massive population demographic in the United States. Secondly, what we're going to be releasing is where the first product that we'll be launching will be a peer-to-peer application, or C2C, if you will. The second set will be a series of business APIs and applications for business to business and business to consumer. And those will go live about the time that we actually launch internationally. So, so to recap, with our an incredible compliance platform, which is unique, very, very strong IP, over 50 independent patents pending. And I put a third box here to represent our scaling capabilities. Tunnel really represents the solution for global payments that we've been waiting for quite some time. Now, we understand that we're launching into a saturated market, but really Tunnel represents a step above. Currently, right now, we own the network from the ground up. We built it by ourselves. It's not a fork of any protocol, and it's ours, soup to nuts. We can do cross-currency payments where none of the incumbents can, at least of these API products that we have. We can serve the underbanked, representing 13 plus people without bank accounts. And we actually offer, or will be able to offer, B2C and B2B payments, which none of the competition can. So Tunnel is ready to launch. We've been building it for 2 years. We've gone through 4 fintech accelerators, and our compliance package, our security, and our team are absolutely amazing, specifically our advisors. Our IP is very, very strong, and we have our banking partner that is tying us into the Federal Reserve System. Now, when I mentioned prior that I would add a scaling box to that previous slide, it's because Tunnel, unlike anybody else, only requires one bank in each currency zone to offer our digital wallet to all 330 million people in the US, or let's say 300 million people, 13 plus. So I can go through the demographics of the underserved and why this is a demographic to tap into, but I'm running out of time already. The market for the 13 plus in the US is massive, and yet they have no peer-to-peer payment system. The way for parents to integrate with their children and have gamified features, spending literacy, financial literacy at a younger age is very important. The parental features I can detail maybe with a little bit more time, but as we launch after the initial peer-to-peer launch, we will have all these features for businesses and APIs to drop every transaction on our network down to zero, which every business is going to need moving forward with this awful, veil that we have over us as that gets lifted. Our advisors are world-class. Our team is extremely experienced, and we have a convertible note open that was following on our seed round led by Boston Harbor Angels in 2018. And our convertible note is for $1 million. It's about half full, but filling up the rest of that note will allow us to finish the network launch, complete a marketing campaign to social influencers for peer-to-peer payments, and launch the 2 applications later in this year. And I guess my time is up. So basically, this will follow on from closing our seed round, or shall I say our convertible note. We'll go right into our post-seed round, which will then launch the B2B applications, the API structure for all e-commerce, and then, of course, the second currency zone will come on after that. So, and you can see the use cases for it, but I'm over my time. I can detail some applications that we have and as a component to COVID. We can do contactless payments, which allow you to safely pay an unencrypted signal up to 6 feet away. And, we're going to be seeing an evolution of payment systems and any sort of interaction as we move out of this and our technology evolves. So I see that I'm over time, so I'm gonna hold up right there, and I'll take any questions from the panel. Thank you very much.
Yeah, thank you. Judges, got 3 minutes for Q&A.
Yeah, thanks for the presentation. I guess my question was, when you spent a bit of time talking about the sort of 13 plus as an age range, or a start of the age range. What is it in your research that suggests that, that consumers age 13 through, let's call it 18, are, unserved in a way that will produce a lot of economic margin?
Oh, that's a good question. So first of all the competition, I'm not sharing my screen. Am I still sharing? Yes, I am. All the competition, peer-to-peer applications in the US are only available to 18 plus. So it's well known that maybe a 17-year-old that has 3 gig jobs needs to pay their car insurance, wants to split a check with their friends, or wants to actually help control their finances with their family. They're receiving money from their parents, but they want to be able to spend it. They have no peer-to-peer payment solution unless they illegally have a Venmo account where all their funds can be frozen if they're underage. The demographic of spending for 13 up is over 250 billion in the US, but the only ways they're most conveniently using it is cash or through debit cards linked to their bank accounts. But because they have no peer-to-peer payment solution, and they are the most globally connected, instant gratification, media and content saturated demographic, I believe since we can do microtransactions at zero cost with instant settlement anywhere in the world, there is going to be a heightened action towards maybe 15, 16, 17-year-olds wanting to send tips to different social media influencers, content that they're seeing. They want to pay for their own Xbox games and so on and so forth. Having no peer-to-peer payment solution in a globally connected world where we can exchange the value and have 100% of even the most microtransaction get from point A to point B with no middleman, I believe is a significant value proposition for that demographic. And I can go a little bit deeper into that, but I want to.
Yeah, this is Alex. So the question I had sort of resonates with a couple of questions that are showing up on the chat here, which is around, because to Dan's point, like targeting a demographic of 13 and over, what's the parental consent requirements? What's the AML process? So you're talking about a demographic of 13-year-olds. So how are you going to go after them given the laws and regulations around minors?
Very good point. So the reason why we can offer this is because of our unique architecture and our compliance package. Our compliance package, by the way, was developed by a number of individuals from US Bank that actually worked on Bill Fox's campaign after 9/11, if you will, to build international monetary movement rules and regulations. But it was our compliance advisors that identified the fact that we could offer this legally with, and these are the key words, permissions and controls. Permissions and controls from parental accounts to children's accounts or teenagers' accounts. Now, it's that digital identity solution that we have, unlike anything that taps into, unlike any of the APIs like Venmo or Zelle or Cash App that sit on top of the traditional payment rails network, we are our own Rails network from the ground up with a digital identity solution that talks to the front end of the bank. And because we don't touch their money or move their data, or vice versa, don't touch their data or move their money, the risk is extremely low. And that data partition allows us to have joint accounts, if you will. So it's in that solution that allows us to have the correct parental permissions and controls for these accounts. And I was hesitant at first, having worked on product development at Warner Brothers games, because we were wireframing the way that parental payment accounts for children's games and permissions of children to have to make payments on games like the Xbox or so on. I was very sensitive to this when they brought it to me first. I said, whoa, this is a beehive you're kicking here. But then once the compliance team got online and said, yeah, Benjamin, we can do this because of the way that you talk to the bank. You can set up permissions and controls between parental accounts on digital identity that allows us to basically build a compliance network that is good with basically US banking. And most zones outside of the US will allow this as well, as we've done our research.
All right, guys, actually that was time's up for the Q&A portion, but Sheila, did you have a quick question you wanted to throw in there, or?
No, I just want to know, do you have anybody using this at this moment? I haven't seen any user numbers, so question. And then one quick thing I would say is, I know you've done a tremendous job on the tech side. When known as financial services, trust and brand is also equally important, if not more. So I'll just throw that out there and love to see how you're moving towards that.
Yeah, that's a very good point. We had trust, compliance, and risk. Banking, international money movement is about compliance and risk. That got beaten into our head during the Queen City FinTech Accelerator down in Charlotte. To answer your first question, our network is currently live with our US banking partner. So we have that partner, the network is live, and so the rest of this note is to polish the first applications or products that will sit on top of the network, polish the APIs, and polish our mechanisms to connect into e-commerce. So no one's using it because the network's live. We're moving money with our US banking partner, and we only need one. And then the first products come out. Sorry, it's right here. The first products come out in Q2, Q3, where we launched the C2C or peer-to-peer in the US, and then by Q4, Q1, we launched the international currency zone with the B2B. So we hope to have users in a few months when we launch the first product on top of the network.
Thank you.
All right, guys, and the rest of actually, as well as with Sheila and the rest of you guys, we are in the feedback part right now. So if you guys can give feedback,
Okay.
great.
Yeah, look, I'll let me see if I can try to give some feedback. I think, it's clear you have a pretty impressive team of people and advisors, and your vision is really big, which I admire. I think, if I could provide one sort of generic piece of advice, it's so much that you're talking about doing that it almost feels like hard to really focus on how you can be amazing at the first thing. And, if for those of us who spent time with Venmo from the beginning, who've tracked Cash App from early on, like it takes a while to get real traction in P2P payments. It's sort of, it's its own thing to be really good at. Even Zelle was a huge failure for the many years before it finally became a success. So, I guess my feedback to you is, if that's the thing, if you really think that's the thing that will be the breakthrough for you, I really wouldn't even be talking about any of the other applications. Or said differently, if you think one of these other applications might see really good traction quicker, it's worth thinking through whether or not, a cross-border B2B payments application might make more sense, because, it might be easier to get customers to send real volume that way, in a sort of quicker go-to-market approach. To me, sort of talking about both the compelling infrastructure that you guys have created, but also a variety of different applications, makes it very difficult for me to focus on the age-old adage about, kind of he who chases two rabbits catches none. And so my advice to you would probably be to almost flush applications 2 and 3 and just sort of talk about, why you can really crush it in one.
It's a good point. Imagine launching a payment system into our saturated US market. All those are stuck domestically, but we launch in the US with our one bank. Until we turn on our second currency zone, like say we have one bank in Paris, that's 19 countries we can then offer it to. That lag of time represents, we thought you were a cross-currency payment system. Why are you only in the US? We have to go live one step at a time. So the roadmap is the United States first, and it's much easier to onboard a user like all of us as opposed to a business. So we put the users online on day one. All 300 million people in the US could download a Tunnel digital wallet and be on the system. And then, we test that, we use it for a while, then we open up B2B and then our second currency zone in Q4. So your point is 100% accurate. We just have to do it stepwise. And the process is to launch in the US first, which is one of the most difficult locations in the world to launch a financial technology product, but we have gone through, submitted our compliance package. We're live in all 50 states, or shall I say, we can legally move money in all 50 states right now. So we're ready to go live with a product on the network. And the 13 plus is because imagine launching into the US and having people be like, wow, what's the difference between you and Venmo? Well, we happen to have a demographic that can't use every other application, but we can. So imagine teenagers, their parents champing at the bit to just have a feature, have the ability to do this. And they're so connected that their communities represent everything that's socially networked and online. So a payment system to be able to move value, not just a like and a heart and a share, but a value, 25 cents, $1 towards a charity or to a friend. That inability right now represents a void that needs to be filled. Nature abhors that vacuum, and we're moving in to that because we can offer it, nobody else can in the US. That will give us the liquidity towards our international expansion with our partners. And after spending 3 months down at the accelerator in Charlotte and having dozens, if not over 100 international banks look at us, of which on our mentor board down there, I think 7 of the 8 that own Zelle were on our mentor board. They were watching us very closely, watching this launch. They're letting our US banking partner de-risk us. And they're sitting there waiting. If our ledger works as we say it does, and we've tested it and shown them that it does, they're going to come after us, as they've told us directly, for ownership of those next zones. And then they'll be ready to build an even greater partnership in the US. So it really is just a matter of one step at a time, launch in the US, a demographic no one else can touch, immediately move like lightning through the most connected groups of people on the planet right now, and then basically spin up cross currency and then B2B at the same time, and away we go. So.
All right, sorry to cut this short, but Alex and Sheila, do you guys have last thoughts or feedback?
Yeah, so for me, my only reaction is, there's risks in everyone's businesses and every segments they go into. It just feels like there's an added risk when the narrative is 13 and over. So I'm not sure if that, to me, I hear a business plan in the fintech space that's targeting 13 and over. For me, it's just like not necessarily a target demographic we're trying to chase from enabling on money movement. So I don't know if you want to downplay that or not, because I think, to your point, that the broader value proposition, it allows 13 and over, but the broader value proposition is to everybody independent of the age. So I just worry that you may get a little bit too much negative reaction to a business plan in the financial services space that allows 13-year-olds to move money around very freely. That's my reaction.
Yeah, every account would have to onboard a parent, so it would totally be permissioned first from the parental account to the child. But you're very good point. Hence my reaction when they came to me and said, "Hey, we can do 13 plus." I said, "Whoa!" Exactly. I used to work in that area. It's very complicated for great reasons, but then we are in desperate need of financial literacy in the United States, financial education, savings and goals, and gamified systems, so younger folks get the ability to manage, manipulate, and see their money and how it works and how they can save, how they can spend, work with their parents. You're absolutely right, and we have a series of arguments to counter that, but you're right. It's all about the permissions and family accounts. So we'll let those decisions be made between the children and the parents, or the teenagers and their parents. So your point's spot on, and adoption will come as a student takes it, or a kid takes it to their parents and say, "Hey, I want to do this," and they'd have to work together and agree upon the permissions the parents will have control over. So thank you all very, very much. Very much appreciate the opportunity, and I hope you and everybody in the audience stay safe. Thank you.
Yeah. Oh, okay. And Sheila, did you have some burning last feedback?
No, I think I have the same feedback as Dan. The only thing I would add is you are addressing many use cases. That also means you have many, many competitors. That's all I would say. I'll leave it.
Awesome. Yeah, awesome. We did go out of time. Okay, guys, let's move on with our next startup. It's Eliza and Isabel Arnold of Arnie.
Hello, just unmuting myself. I'm Eliza and my co-founder is Isabel. I hope you guys can see us all. Okay, so we'll get started. Thank you all for having us so much. Okay. Hi, so just a little rebranding. I'm Eliza.
And I'm Isabel.
We're the co-founders of Arnie, which is an automated portfolio builder for the ethical investor. So right now, sustainable and impact investing is at an all-time high. We've seen impact investing assets under professional management increase almost 40% in the last 2 years alone. The institutional market is clearly getting served, but no one is meeting the needs of the retail investor. Even though 84% of these retail investors have said that they want investments that are specifically customized to their values. So the problem is access to this type of customization is very expensive. You need to meet the minimums for a private advisor, which are often around $1 million. That leaves out 95% of American households who don't meet this threshold, and in total, they hold $14 trillion in aggregate.
So currently there are 3 main avenues for having your investments managed. Like we said, you can go the traditional wealth management route and get a total investment solution along with sustainability customization. But like we said, that's not cheap and it's also not convenient or online. You can go the robo-advisor route and also get a total investment solution that will be cheap, online, convenient, easy to access, but won't offer sustainability customization, and at best kind of gives you just a like check the box impact option. There are also some smaller sustainability portfolios offered online that do give you customization based on your values. They're cheap and convenient, but these generally only offer portfolios of US equities, so at most this would be seen as an add-on to someone's core portfolio, and they're not going to put a ton of capital there. So you can get 2 out of 3 things, but no one offers all 3 except for Arnie.
So obviously the traditional wealth management industry is massive, but there's also some robo-advisors who've grown pretty popular. Those are the Betterments and the Wealth Fronts. So there's a clear interest in online wealth management. We fill a specific gap by offering full sustainability customization to the retail side of the investor market.
So these successful robo-advisors have taken advantage of some cool new innovations in investment technology. So, streamlined online account opening, automated portfolio management, online trading. We realized we could take this a step further and make full sustainability customization accessible by using other innovations, so things like fractional share trading, which means you can own individual stocks directly instead of just funds, even with a pretty small account balance. And other innovations like index optimization mean that we can take users' preferences and within seconds determine the ideal weight of each stock for their personalized portfolio.
So our onboarding process is very simple and streamlined. It gives the user a lot of choice and control, but it's not confusing to someone that's unfamiliar with investing. Users can choose up to 15 sustainability values, and that's what we build their portfolio around. They answer a standard risk tolerance questionnaire, and they end up with a multi-asset class, risk-appropriate, and fully customized portfolio.
So why is now the perfect time for Arnie? Like we said, interest in sustainable and impact investing has increased dramatically in recent years, and millennials are particularly enthusiastic about this practice, which is good given millennials are set to hold as much as $20 trillion by 2030. And not only is there demand for sustainable investing, but trust in online financial platforms is also on the rise. So, this is not a new concept to anyone putting their money on an online platform.
And looking at major headlines around the world, it's clear that sustainable investing is a trend that's here to stay. We saw the same thing when we spoke to our potential user base. They all felt the exact same way, but they also made it abundantly clear that the current solutions that are available to them aren't cutting it.
So we actually just recently finished development on our prototype, and we're beta testing that with users now. And so our platform will be launch ready once we can complete some final integrations with a few third-party service providers. So namely, custodian and clearing firms, since we're obviously not a brokerage firm. So we need someone to execute trades. So our product is already designed and built to accept all those APIs. So, in my background as an investment manager, I saw increasing demand for values-aligned portfolios.
And as a creative director, all of my clients were asking for purpose-driven work. So it became very clear that consumers wanted to speak with their money. And that's us. Thank you very much.
Thanks so much.
All right, thank you. Judges?
Yeah, so are you technically an RIA now, or is that your plan to be an RIA from a regulatory perspective?
Yeah, we're in the process. We have an outsourced compliance team that's helping us register with the SEC as an RIA.
Got it. Okay. What when you think about just the market opportunity in front of you, and I saw the stat of $20 trillion for wealth for millennials, and I get the point. But if you had to look at that wealth and like, how much of that do you think is mass market versus, mass affluent versus high net worth, and how much of it is in taxable asset, sort of taxable assets versus non-taxable investments, or taxable investments, I should say, and non-taxable investments? Said differently, won't a lot of that be in retirement assets, which won't be really accessible to you unless you guys start creating products that you can distribute indirectly?
Yeah. So yeah, I mean, to your point, kind of the largest set of investable assets that, households have are their retirement assets for this, particular market. And so that was kind of the 95% of American households that we hit on earlier hold, 14 trillion in aggregate. That's kind of those that have less than $1 million in investable assets. And so, yes, a lot of those will be in retirement accounts. So we do plan on offering IRAs in our initial launch. And then longer term, we do want to, partner with 401k providers to be a sort of sustainable option for employees. So they could, this would be an option on their online platform, and they could, build their own sustainable portfolio and have their 401k invested in that. So we'd certainly want to take advantage of retirement assets.
Other judges?
You mentioned fractional shares as one of your competitive advantage and something as a differentiator, right? SoFi too launched that recently, or is launching. I don't know if you guys heard that, but SoFi certainly has cornered the market on the millennials and also have an investment product. And now they are also offering similar. So I think I was looking for what your differentiation is, and you mentioned that. I would love to see more points of differentiation, because there are a dime a dozen of these investing online platforms. I agree with you, nobody's doing all three offerings. But having said that, I think there is, if you are with a investment provider right now and you're happy with them, there is no reason to change, right? So I am still struggling to understand what your differentiation is and how you would really be appealing to the market.
Yeah, so we're sort of targeting, I mean, you can certainly access fractional share trading through a lot of trading platforms, like you said, since that technology is now out there. Mm-hmm. So we're targeting those that would look for a betterment or a Wealthfront type service, and just, here's $10,000. I'm going to answer some easy questions because I know nothing about investing, and you're going to build me a portfolio and invest it for me. Versus, I'm going on my Robinhood account or some trading platform and choosing investments for myself. Mm-hmm. And so, we see our main competitors as the current robo-advisors that offer you a, fully, multi-asset class, risk-aware portfolio. And these have just sort of all just offered, a set of funds. So they pick what asset classes work for you, and then each one is kind of filled with, usually a cheap Vanguard ETF. And so we think, instead of owning an equities ETF, since you can use fractional shares, why not build someone a customized equity portfolio? And so that's where I think these robo-advisors aren't going down that avenue and have kind of been focusing on other things like cash management. And so that's where we see different.
We've seen a lot of people actually want to sort of define what sustainability is to them. So it's not just a blanket sort of like greenwashing and click the ESG box. It's actually, I personally really care about board diversity and equitable CEO worker pay, and I want to do something about that. It's very hard to actually do something about that if you see that that's a problem in the world. So what we are offering is people an avenue for this type of activism that they want, but also benefiting themselves in the meantime.
Got it. Okay.
It might be worth, I don't know if we're mixing in feedback here as well, but maybe just I know you have an interesting combination of backgrounds, both with the investing and the, kind of the brand related experiences. It might be worth just thinking through kind of what's the content angle here for customer acquisition, because the content and community piece is actually it's such a big part actually of what worked for Personal Capital, what works for Ellevest. You know, and candidly, if you look at some of the other players who've, you know, in the investing world that have had some success, like you actually have to build a broader community in order to get people's attention and engagement, because it's so hard to acquire a customer. It's so expensive to acquire a customer who's right at the moment when they're going to like make a decision on allocating thousands, tens of thousands of dollars of their portfolios. So just something to think through, you know, as part of your story, like how do you do that? You know, could you create a top of the funnel that engaged a lot of people around exactly what you said, what, you know, ESG means to me, and then, you know, kind of you can create the actionability of creating the portfolio at the right time for the person.
Completely, that's something we're very much thinking about. One of our main ways in is basically ongoing engagement. So we, it's both user acquisition and ongoing engagement. We respond in real time to real live events. So if, you know, the Amazon rainforest is going up in flames, we can sort of speak to that and give people a way to actually take action. Not just through a donation process, but that's sort of where we can hit people and pull them in. And we also do plan on having, when we can all go back outside, community events that are focused around specific values that we offer. So, you know, there'll be sort of like environmental ones focused on deforestation and, you know, ocean cleanups, things that we want to basically, we want to make sure we have a solid community base first before we, you know, need to just focus on purely just the user acquisition.
And then, you know, everyone will have sort of their, you know, own kind of content feed, and will get, you know, targeted emails and communication based on the metrics they've indicated they're interested in and their portfolio companies. So if you have Facebook in your portfolio, they have, you know, do something, you'll receive some sort of notification about that. And, you know, your portfolio might respond to that by, you know, investing, divesting. So we kind of keep users engaged past the portfolio construction process, which we haven't really seen in other robo-advisors.
Alex, I think we haven't heard from you, or we're definitely in our feedback time, so you guys can feel free.
Yeah, I guess I just mixed feedback. I look at this and try to figure out, you know, if I have an asset, I have a balance sheet of capital I want to deploy and I want to build it in my 401k retirement. Maybe I'm old school, but my singular focus is return, right? So I'm putting in asset classes where I think I'm gonna have the best return, and whether or not it's diversified a bunch of different asset classes is fine. Would I sit there and think, okay, the social impact of this, or you know, what's the implication of my investments in particular outside of return? So when you look at somebody who's got X amount to deploy, what percentage are they actually looking to allocate to this? I think it's much smaller than reality. They may return a survey that says 84% of them want to have this sort of impact, but if that impact is single-digit return versus I can allocate it over here, it's double-digit return, I think it's my money. I'm going to put in double-digit return. So I always question whether or not this is perceived as where people wanted to put their capital from an allocation basis, or in reality. Because if people were putting that in reality, you would see it in the numbers today, and I'm not sure if that's true.
Yeah, and this, I mean, we don't assume users are willing to accept anything less than kind of market rate returns. So, you know, that's why portfolios will be built. And when we run this optimization calculation, there'll be, you know, restraints on expected tracking errors. So the assumption is that you're still getting market rate returns. And it's not that, you know, your portfolio is massively different than the underlying index that it's based on. So, you know, a company that's rated maybe not so great in a metric that you have interested in, you know, you've indicated interest in, might be weighted less, but it's not necessarily going to be knocked out of your portfolio completely. And a company that is rated really highly and something that you care about might be weighted more, but you're not going to see, you know, companies that in the underlying index rated, you know, that are weighted 0.2% suddenly become 5% of your portfolio. So, you know, the financial factors are just as important as the sustainability factors, because like you said, you know, people still want to make money with their investments. So
it's not a charity.
Exactly.
Yeah.
I think there's some good data on ESG and the success that it's had in recent years. So I mean, I'm optimistic for that part of the plan. I think when you look at, you show the asset sizes of some of the robo advisors, and you show that, you know, Ellevest doesn't have nearly as big of an asset bubble as, you know, some of the other players. They've been around longer, but it's also just recognized as you sort of, your differentiation is that you're three things, not one thing or two things. as you are more of those things, actually the sort of, it's, you know, it's really about how much of that intersection is going to be resonated, you know, for how much of that intersection will that resonate, you know, kind of the message. And the more specialized, the smaller that population might be. So, you know, it'll be important to make sure. That's why I said, build the community first, build a really big top of the funnel.
Isabel, one feedback I would have for you is to have that story of how you ensure at least market returns as part of your presentation, as part of your story. I think that didn't come out because as Alex was speaking, that's exactly what, you know, I was thinking is, well, you are really getting people to put their money where their mouth is or where their heart is, right? And that's what you're trying to do. And how do you do that best? And why would somebody do that? And do that in a fully engaged way, 100% way. So I think that those points, if you bring them out in your presentation, would be great.
Definitely. Yeah. I mean, we realize we need to align people's financial goals with their sort of impact goals to get them to do anything.
Right, exactly. And you have that, and you have thought about it, right? So it's just not coming through your story. So
Thanks. That's really
Well, thank you all very much.
welcome.
Yeah. All right, guys, we're moving on. Sorry to cut you guys short, but okay. All right, so next we've got Nuri Otis with TechSmarter. And
Hi, good afternoon. Hey, Anna. Nice
Yeah.
to see you again. My name is Nuri Otis, and I'm the CEO and founder of TechSmarter. I'm going to go right into this because I know we are running a little bit behind schedule. So bear with me. Okay. So I'm going to start with the summary because it actually gets the most important points apart. What we have done is we have built the only fully compliant service that allows all communications on both iOS and Android devices to be archived real time. This must be done because it is a requirement of FINRA and the SEC and a whole bunch of 3- and 4-letter acronym organizations that have oversight over everybody in every company that has something to do with money. The current solutions, most of which are 10 to 15 years old, they require a secondary application to be put on the device. And the problem with it is that it causes leaks. It does not pick up messaging that is native to the device. So if you're using iMessage today with the incumbents that are in the space, you're not getting the majority of the messages that are being sent. And to just give perspective, iMessage is approximately 1.6 trillion messages per day, and SMS is something north of 145 billion. So let's just call it 1.7 trillion messages a day that are not being covered. And you've got organizations such as FINRA and the SEC, FCA, et cetera, that have been overlooking or have been looking at this for a long time, but have not found a solution. We're the only platform that collects, encrypts, archives, and reproduces all messages real time, mitigating inherent risks. And just again, for perspective, sanctions last year for non-compliance, and not just messaging, all non-compliance, were north of $300 billion. Okay, why didn't you move? Here we go. There's some really big risk issues that occur regardless of the platform that you're on. Once a device has more than 10,000 messages, it begins to delete the device. Our service eliminates the need for financial institutions to provide their employees with secondary devices. This will save them millions of dollars per year. The other issue that occurs is that when it is a BYOD, I cannot speak today, my apologies, a BYOD problem, when the employee leaves, all of the data walks out the door. With TechSmarter, you get all the benefits that text messaging provides, mitigating the inherent risks. As you can see here are the regulators just in the United States and the UK that have enacted regulations that require this. And you can simply look at what has happened in the world in terms of the number of text messages sent on a monthly basis. When you add iMessage, the numbers are outstanding. One of the biggest misconceptions that we run into, and at this point, one of the 5 largest banks in the United States has been piloting our service since before Christmas. When we first started talking to them, they were under the impression that they could call AT&T or Verizon or T-Mobile and get messages. And the answer is categorically no. We spoke to all of the carriers and all of them have confirmed to us in writing that messages are not available from them in any shape or form. The most important rule that exists here, and you've got both SEA regulatory notices and FINRA, is that any firm that intends to allow people in the organization to communicate via a text message, via Facebook Messenger, via Slack, any type of non-oral communication, that data must be backed up. It must be backed up for, depending upon the agency, anywhere from 5 to 7 years, and if you're in Oregon, it's 10. Our system is very simple. It can be installed and activated on any mobile device. All the data is encrypted and archived. The only people who can unencrypt it are our customers. All devices are managed through an admin panel. What we are is an enabling technology. Everything is permission-based. So we fully comply with CCPA, we fully comply with GDPR. We have taken a very slow and deliberate approach to this for two real primary reasons. Is that we recognize, as Sheila said as we began, that trust and brand are the most important things that we do. And we know that our customers will be some of the largest financial institutions in the world. So what we've built is something that works. When you look at our competition, all of them formidable, none of them access native messaging applications. Everything requires a second phone number, and none of them plug the leaks that TextSmarter does. We can go into our projections, our progression, go to market. Again, these are things we can go into at a deeper time. We have defensible IP. We have 2 patent applications that are in process. We actually communicated with the lawyers today to continue to push these through. This is a $300 billion market opportunity. When you look at the various areas that we focus on, private funds, insurance companies, HIPAA, archiving, etc., you can see that it's a very large area and covers a lot of different areas, or a lot of different verticals. We are primarily focused on the finance part of it to begin with, which represents the majority of the verticals you see in front of you. We have a very experienced team that has been around this for a very long time. And you can see here, this is a direct quote from, I won't go into who it is, but this is from an executive director at one of the largest private banks. They participated in the solution since Christmas. It's simple and powerful. We've made regular improvements, and then they say something nice about me, and I paid them well to do that, and I'm just joking. That is our presentation. If you have any questions, my email and phone number are here. It would be nice for us to talk to. I would be happy to talk to any one of you. This is a compliance play, everybody. This is a very, very large opportunity, and we feel that we've put the right team together to continue to execute and to build a large scalable business.
So Nuri, thank you so much for presentation. It was amazing. How do you gain customers? What's your strategy?
Well, as our customers will be primarily financial institutions, there's a very broad range of customers that we're focused on. In terms of gaining access to them, what we've done is we've begun a grassroots education. Most of the companies, most of the banks that we speak to, they don't yet know and don't take seriously the regulations that FINRA and the SEC have put forth. But if you go to the SEC website, you'll see that there are monetary actions that they have taken going back 10 years. You guys talked, Alex and Dan talked earlier about opening an office in Europe, and I cringed because that's something we did in January. But we did that because we spoke to the FCA last year, and they told us that they were going to begin to enforce this in London this month. Now, I don't want to harp on COVID and everything else. It's a challenge for all of us, but sometime in the near future, they are going to hold these organizations accountable. We had anticipated installing our first customer this month. They've asked us to wait till June. So we are literally a seed, perhaps a late seed stage investment. What we're looking for is a couple of $1 million and the right partners. And in talking to people at large organizations, one person happened to, he's with a firm in San Francisco. He looked for a solution like this when he was with JPMC for 3 years, and he's now on the brokerage side, the investment side, but he was very excited by what we've built because he spent 3 years looking for this and nobody else has been able to build it.
All right, so judges, did you have any questions that you also want to add to?
Yeah, look, I guess let me give a question and feedback. I think, Nuri, first of all, it seems like a real need. My advice to you is take a lot of the content out around trying to demonstrate the problem and need. Okay. I think anybody who you talk to who will invest in you should understand this if they're a sophisticated investor in the space. So I'd say try to condense the 6 or 7 slides down to 1, maybe 2. I agree with you. Clearly there are a bunch of other competitors. So I think the piece that doesn't come across to me that I would love to understand, especially as a former mobile infrastructure investor, is can you just explain, in a way that obviously doesn't share trade secrets, what is it that you're doing on the device? I think I understand a little bit about how these devices work. So could you just explain what it is that you're doing that enables you to avoid the app install or, kind of the separate phone number?
Well, from an Android perspective, we are the only company that Google Android has given permission to archive data for compliance purposes. So that is simply an application that lives on the Android device. Okay. The Apple side of it is significantly more complicated and it is extremely proprietary, and I have no idea who's on this call. So okay. It's something I'd be happy to discuss in a more private nature.
That's fair. I guess what I'd say in a pitch setting, just because I think the goal is to give you actionable feedback. I think that needs to come across easily and clearly in a pitch with anybody like me. I understand this is an open pitch setting, so I totally get that. But I think that'll be an important thing to be able to communicate clearly and easily in the presentation.
One of the most interesting things that have come out of the last 30 days has been the growth in mobile. Mobile data activity has increased by over 30% since March 11th, and we don't see it stopping. And when we look at the numbers and we talk to the carriers and people in the space, they're seeing a lot more of this information. And the only thing that not having a service such as ours can do for large financial institutions is raise their level of exposure.
So Alex and Sheila, do you guys have any questions?
So this is a compliance product. I think compliance always has a long, leeway in terms of when it's to be deployed and when you actually become compliant. So I'm not sure. I was trying to understand what the timeline is when the rules came out and how compliant people are and how much leeway they have. The reason I ask that is because, having worked in financial services, there is compliance and regulations happening all the time.
Right.
Most merchants and most companies are very, very slow at even recognizing them and deploying them. The other triage that happens at customer side is if I do not comply, what are my costs, right? And to comply, what are my costs? So I was looking at it, you're collecting data. Of course, there is tremendous cost associated with storing that data, right? And so what are your costs? What is your business model? What are your costs is something I was looking for. I didn't know whether you already had that or are still waiting to deploy this. There's a little bit confusion in terms of where exactly you are in your product and how does that apply to the market.
So we have a very simple SaaS model, and it will be $250 a device annually, or $25 a month, depending upon how the customer wants to do it. Then the storage part of it is we've negotiated very strong relationships with GCP, AWS, and IBM. We don't have an Azure relationship at this point, but it's something that we're working towards. What we will do is it's going to depend upon the number of people that are involved, the number of devices, and how many text messages a day does a person send. In October and November of last year, the only person that was on our system was me. And both months, my activity was in excess of 5,000 messages, which is kind of embarrassing for a 50-something-year-old guy. But it's going to depend completely on the volume of the people. If the employees of a financial institution are people that post on Facebook often, if they're on LinkedIn often, if they're on Twitter often, all of those become areas that are required to be archived. One of the things I don't think that I said that I think is really important is that this is a real-time backup. So Sheila, if you sent me a text message now, I could immediately go into our rear back end and I could show you the message. I could show you your phone number. I could show you your geolocation. I could show you the message that was sent. And that is all that is required per the regulations of the organizations. And to go back to the last thing, the regulations of FINRA happened in the middle of 2017.
I'm so sorry to have to interrupt. Yeah, Dan actually has limited time, and we want to get to the last presentation. Okay. Please feel free to, if you need to connect with each other, I'm more than willing to do that. So afterwards, please, reach out to me. I'm so sorry.
No, I talk a lot. I get it.
All right. So Al, let's move forward with your presentation. And I'm so sorry again.
I'll apologize. Unfortunately, we've run over quite a bit, and I just want to make sure we get to see Coil.
Yeah, I have a meeting at 4 as well.
So we see your presentation, but we don't.
Yes. Can you see me? Can you hear me now? Okay, perfect. Okay. So hi everybody. My name is Aliash, and I'm the co-founder of Coil. So let me tell you a little bit more what Coil is. So Coil is a payment-enabled smartwatch bought by banks in bulk and given away for free instead of plastic cards. Okay, so did you know that 83% of Generation Z would like to pay with a wearable, but only 14% of them actually has one? So that all of the Apple Watches, all of the Fitbits, everything that you can pay with, it's only 14%. So that leaves 69%, almost 70% of the market completely untapped. So why is that, right? Because current solutions are really, really expensive. Apple Watch is $400, which is a lot of money for a lot of people. And the cheapest solution that you can pay with is $160, now $149, $150, and it's a Fitbit. So why are we targeting banks, right? Because, well, banks, they don't have enough differentiating products to differentiate one bank from another bank, and that's why they're losing to fintechs, right? That's why they're really desperate right now to compete with fintechs, because they're bleeding Generation Z to companies like Revolut, N26, Venmo, and Apple, Google now, and all the others. So now we can ask, right? Everybody has a phone. Why wouldn't they just pay with their phone, right? Yes, everybody can pay with their phones, but according to Apple, people are not paying with their phones. Only 24% of iPhone users are actually using Apple Pay on their phones to pay in brick and mortar stores, against 80% of Apple Watch users using it actively every day. So there is a huge gap. You know, it's not a 10% difference. So there is a big opportunity here for banks that with Coil can get new customers from other banks, retain the old ones from switching to fintechs, and on top of all of that, increase transactions, which we're going to talk about a little bit later. So till now, we signed up 3 banks in Europe. We have 22 banks in the pipeline. We will deploy 150,000 devices this year. And our current pipeline interest is about 10,500,000 devices. We're raising 1.5. With this, we're gonna launch the first 3 banks that are already signed up. This is our team. It's a really experienced team. I'm a serial entrepreneur with multiple exits, with my first one when I was 18. My co-founder was a manager at McKinsey in San Francisco. Then we have bank presidents. And of course, we have our CPO is a team lead that built a leader of a team that built Apple Pay, Garmin Pay, Fitbit Pay, Apple Pay, pretty much any pay you can think of. And our advisors are Stanford professors, C-level employees of Pinterest, IIM professors, really high employees of Philips and Singtel, and so on. So let me tell you a little bit more about our device, what it can do, right? It has all the smartwatch capabilities. You know, you can instantly jack calls, you can see all the notifications. It has, you know, fitness tracker capabilities, basic ones, and then, you know, you can run apps on it. It has, because it was built with payments in mind, it has really strong security and encryption. And it also has a lot of unique features that you're not going to find anywhere else. So of course, you know, you can just swipe through cards. You can check balance. You can select multiple payment options, including real-time payments. It gives you card recommendations. You know, it has MiFAR technology, HID technology, and it holds all of your access cards, majority of your access cards as well. And it also works even when you ran out of battery. This is the most important thing, because if you want to replace a wallet, it has to work. And if you compare it to a couple of other devices, you see, because it was built for payment, it has, you know, unique features that none of the other devices had. So let me introduce you to your first financial health bracelet. And because it's not just, Coil One is not just device, right? Because it's connected to a bank, it needs to have a couple of moving parts. So first of all, it has Coil Pay and Coil Dev. So Coil Pay is a integration software that allows integration with any existing bank payment solution in the backend, thanks to IBM. And Coil Dev is a development solution for Coil wearables and App Store for Coil One users. Because banks don't buy 100 devices, they buy 100,000 devices, right? It makes sense, and we can deploy a lot of devices essentially overnight. We built an app ecosystem behind it as well, where banks can now go and deeper their relationship with their customers, because now they have access to their wrists, and with their business partners as well. You know, grocery store collection points, you can collect points, you can do club memberships, hotel chain access, you can have instant loans that banks can offer. You know, like, I need $20, can you loan me this $20 to buy shoes? Spend restrictions, and on top of all of that, you know, we gather a lot of analytics from users. So market is really big, 200 billion. It's going to quadruple in the next 5 years. We expect to deploy in the next in the next year and have deploy 5 million devices. And we make money from selling the devices, which is $15 to $20, which is still not too much, but enough for banks, because this is a customer acquisition tool. And we also sell to marketing departments, so they can make a decision faster. And we take a cut from each payment. And of course, we make money from apps and add-on services as well. So if you have any questions, please let me know. And if you would like to see how the device works, I would be glad to show it to you live as well.
All right, guys, judges, Q&A.
Yeah, it's a good presentation. Thank you.
Thank
I
you.
have a lot of questions. I'll just try to cover the specific ones. So first off, do you already have do you already have the reference design that is spec'd out at that price to deliver margin at that price point?
Yes, we have a wearable, and we can deploy it. So it depends how many they buy. The cheapest we can go is $15, and if they just buy like 1,000 devices, it's going to be around $25.
Okay, and you know, there's a question asked by one of the attendees that I also was curious about. Can you just talk through the effectively issuance and authorization paradigm here? So like, is this network tokenization with a secure element in the device? Yes. Okay, so not host card emulation. Like, wait, are you already certified with the networks? Like, how just talk
yeah,
through that.
So we have two solutions that then I can talk about that deeper if you want. But we have one that is certified with MasterCard and Visa, which we are currently right now in the process, and we are using the MiFAR technology from NXP. And we have another solution that does not require any certification, and it can be deployed pretty much instantaneously.
I'll let other people ask questions. Thank you.
Yeah.
This is Alex. Interesting concept. It certainly is a bit different. I guess my concern is that it's counter to the more macro trend, which is the getting rid of these standalone devices that are single purpose, right? So you can go get credit cards today, you might as well just preload them on a phone. We know definitively that there's a one-to-one correlation with the person in the phone. I'm not sure if there's a one-to-one correlation with the person in wearing this singular use device for payment. And given that payment transaction volume is random versus mobile phone use, which is consistent over a 24-hour period and 7 days a week and 30 days a month, for me, it's just counterintuitive that I would get a device that has a single purpose like this, where you see a lot of the functionality of the IoT devices themselves have been migrating their self and their way into mobile devices, because there's no point in having a standalone device for it. So I guess I'm struggling with that as a standalone value proposition. And number one or two, the cost to replace this device is orders of magnitude more than the cost to replace your credit card today if locks are broken. So there's all these other questions around just theft and risk and all that stuff. So that's where I'm struggling with, just from a high level value proposition.
Of course. I would, of course. So let me answer first question. Yes, so it is more, right? To issue a card is from $4 to $6. It depends, right? Where you are in the world. But a customer acquisition price, like you said, it's going down, but it's still around $180 to get a new customer in to switch a bank account, right? And this is a tool for them to do that. So even if they spend $20 on a wearable, and then spend another $20 to market it, it's still a magnitude cheaper, 4 times cheaper to get in a new customer than it would be, than it is what it is right now, right? Purpose rebuy is around 2 years. It is more, but it does offer more, right? So we do have purpose built, I'm not going to say devices, but for our finances, everybody has a wallet, right? And people are not paying right now, are not paying with their phones, because it's not a better experience than taking your...
I think you got to leapfrog the generational issues you see in the US, right? Just go to Asia.
Of course.
Nobody carries a credit card. It's all contactless payment.
Everything. And it's even, and now it's even transforming into even more contactless payment. Cash is going away. It was going away, and now it's going away even faster, right? And everybody is just going in that contactless experience. But again, if you look at all of the other devices, right? So you look at Apple Watch, and you look at Garmin, and you look at Fitbit. Everybody is adding payments to their devices because it brings repeated use to the device, everyday use, right? And there is a trend here, and people are using that every day. So I'm not saying we're going to replace the phones for payments, but there is a niche here for the younger generation to be using those devices. Yes, of course. Dan?
Dan's got to run.
Oh, I'm just saying goodbye. I have to run, guys. I just really
okay.
appreciate you having me. Thanks.
Yeah.
Thank you.
Hi, Dan. All right, Sheila and Alex, let's, do you guys have any more feedback and questions?
Here's what I would say. Can you tell me if this wrist watch has been accepted everywhere? What is the acceptance of this? Does there need to be any kind of special arrangement with the merchant for them to accept the payment?
No. This is Visa, MasterCard. This is as much as you would pay with your phone or with Visa. So this is completely the same. And because it's issued by a bank, it allows you to have, look into your bank account and everything else. That's
is it NFC payment? So is that what is the element that's in there? Are you doing? It's not a Stripe or Mag. So are you using NFC from the terminal where you're paying?
NFC, yeah.
Okay. So okay, so that's that. The other is that I always have heard big tech getting into financial services. Apple trying to become a bank, Amazon trying to become a bank. Yes, fintech trying to get into big tech. So interesting play there. But having said that, I think the other feedback I would have for you, which is a piece of data that you keep quoting, 80% of the people using the phone pay. Anything can be proven with data. So what I would say is how many people actually have the phone and why are they using that phone to pay versus how many people have the phone and don't use it to pay. That's something I would look at, because there is equal argument to be made for just having a mobile phone and not having a second device, which is what I think Alex was trying to say. And there's equal argument, if you ask me, that a wristwatch is better than phone, given, say, you're trying to pay at a terminal or, trying to pay at other places where you have your phone in your purse and a wristwatch on your hand, right? So look at those underlying details of your matrix and then come up with a story. I'm a little bit struggling as to, how true this is. Which of these, numbers really matter is what I'm still struggling to understand. So
this is not, I didn't came up with that data, right? This is McKinsey and Visa's data, but thank you.
Yeah, I think like I said, it was an interesting spin because to your point, talking about Apple's and likes getting into fintech. You're talking about fintech getting into the IoT space. By the way, it's just different. Would not expect that someone would get a wrist-based device just for payments when they already have the mobile phone definitively, on their presence. And then by region, it varies, right? So, NFC is still pretty weak in the US. How many times I try to go to contactless payments today, and I still have to pull out my credit card. Whereas when I travel in Asia all the time, I'm the only person that pulls out a credit card, right? So everything is contactless payments. So it's an interesting spin, and obviously you could play to the point maybe to some of the folks that are on the previous calls here about, can you take COVID-19 situation and leverage that to your presentation? Yeah, by default, right? Because you accelerate the contactless payment space. But yeah, I don't know, maybe there's a niche market, and that did concern me when you said niche. As investors, we don't like to invest in niche markets.
Well,
right?
I don't mean niche. So when I say niche, like it's still 1.6 billion people from Generation Z. So that's still a big
So
market.
just the last question I'd ask is, what is the target market? What's the target market? Where do you want to go to market first?
So where or to who?
No, which geography?
Okay, so we're launching in Europe. In Slovenia, and then we're launching as well. After that, we're launching in the Middle East. We were part of the startup bootcamp in Dubai, fintech program, and we're talking with Visa, and Visa is actually thinking of acquiring a couple of thousand of devices just to give it to a bank as well. And we are talking with HSBC, Shrek, and a couple of other banks there in that region as well. And we talked with the second largest Mexican bank. They said they would like to have 500,000 devices, but that's way too much for us to deploy right now. But yes, so there is big interest in that area.
Cool. I apologize. I do have to run because I'm 3 minutes over for another meeting. I'm supposed to be at right now, but
yeah.
Thanks, Algis.
Thank you.
Yeah. Okay. So Sheila and Alex, if you do need to go, feel free. And of course, either they'll reach out to you or, through me.
We're done with the presentations, right? So we're good. Thanks, everybody.
Yeah. Thank you so much, Alex.
Yeah.
Good night.
All right. Bye-bye. Thanks, Maya.
Yeah. And Sheila, I just wanted to say, maybe, did you want to add to that before the event?
Definitely interesting. I think, since you're looking for investment, certainly approaching maybe a millennium investor is another idea. Looking forward to it. This is interesting. I, in fact, advise a company doing something similar. We have a thesis about it, certainly. So yeah, definitely happy to chat later on. Really glad to see this. I like that the banks is giving this away free for now to test market. So good luck with that. I think that'll be very interesting data that you will collect. So I think very, very highly anticipated product. Definitely give it a try. So
thank you.
Good space. Yeah. Thanks so much. Good luck.
Yeah. All right. Awesome. Okay. So thank you so much, Sheila and Maya, and to all our startups that pitched tonight or today. It's like night my time on East Coast. Okay, so that concludes our event. I guess I just wanted to, there's one more, I will share one screen. We've got a bunch of other pitches in different industries happening. So please look out for our events. If you are a startup, you can reach out to me. If you're a VC who would like to participate, also reach out to me. And we can take it on from there. And everyone, thank you again so much. Have a great night.
Thank you.
Thank you.
Bye.
Bye.